Good morning today, July 9th. Let's walk through a summary of what's happened in the global financial markets. Have a look at the dashboard while I walk through some key highlights. The global financial markets on July 8th, 2025 reflected a complex and shifting environment. U.S. stocks had a mixed to lower day, weighed down by renewed tariff uncertainties, even though jobs data earlier in the week was strong. In contrast, European and Asian markets saw modest gains or mixed results, showing regional differences in performance. Bond markets were active, with U.S. Treasury yields rising sharply, especially for the 10-year bond, as strong labor data reduced expectations for an immediate interest rate cut by the U.S. Central Bank. This trend was echoed globally, with concerns about government borrowing costs in the United Kingdom and Japan. The U.S. dollar strengthened against the Japanese yen and European currencies, driven by differences in central bank policies and interest rates. Commodities like oil and gold declined slightly, as easing trade tensions reduced demand for safe haven assets. Central banks were a major focus. The U.S. Central Bank kept its interest rate steady, and the likelihood of a rate cut in July dropped significantly. The European Central Bank signaled a new long-term strategy to include climate considerations in its policy, possibly introducing incentives for green investments. The United Kingdom's central bank highlighted fiscal risks and high borrowing costs, while Japan's central bank maintained a cautious approach, contributing to a weaker yen. Australia's central bank surprised markets by holding rates steady despite expectations of a cut. In the options market, there was unusual activity. Large purchases of put options on a major U.S. equity ETF suggested institutional hedging or bearish bets, while heavy selling of call options in a major technology company indicated expectations of limited upside. Business news included a major financial institution expanding in Charlotte, North Carolina, and the start of a major online retailer's sales event. Regulatory filings showed new rules for market transparency and the introduction of new cryptocurrency investment products, signaling the growing integration of digital assets into mainstream finance. Looking ahead, the report anticipates continued market volatility, driven by ongoing tariff discussions, upcoming U.S. inflation data, and further central bank commentary. Opportunities may arise in defensive equity sectors, certain fixed income maturities, and currency pairs affected by central bank divergence. Short positions in sectors vulnerable to policy changes are also being watched. U.S. large-cap stocks were mostly lower, with the main index and the Dow down, while small-cap stocks showed resilience. The market's quick recovery from tariff-related drops suggests investors see these threats as negotiation tactics rather than firm policy. Internationally, European markets posted small gains and Asian markets were mixed. Bond markets reacted strongly to economic data, with U.S. Treasury yields rising and expectations for a rate cut diminishing. Higher yields increase borrowing costs for companies and consumers, which could slow economic activity. Globally, bond markets sold off, with Japan and the U.K. seeing notable increases in government borrowing costs. The U.S. dollar gained against major currencies, especially the yen, due to higher U.S. yields and differences in central bank policies. The Australian dollar rose ahead of its central bank's decision, but then the bank unexpectedly held rates steady. The Chinese central bank made small adjustments to keep its currency stable. In commodities, oil and gold prices fell slightly as trade tensions eased, reducing demand for safe haven assets. The U.S. also announced plans to raise tariffs on copper imports, adding uncertainty for industrial metals. The U.S. central bank has kept its interest rate steady, and expectations for a near-term cut have dropped. Strong jobs data has made the central bank more cautious, and any further strong economic indicators could delay rate cuts even more. The central bank's liquidity management tools are working as intended, with no signs of stress in short-term funding markets. The European Central Bank is moving to include climate and environmental factors in its policy, which could shift capital toward green investments and away from traditional energy. Bulgaria will join the euro area in 2026, further integrating the region. The United Kingdom faces high borrowing costs and rising public debt, with regulators focusing on financial stability and possible reforms. The Japanese yen continues to weaken as its central bank remains cautious, making it attractive for investors to borrow in yen and invest elsewhere. Canada is working to reduce internal trade barriers, which could boost productivity and influence future monetary policy. Australia's central bank surprised markets by holding rates steady, citing uncertainty and a strong labor market. This cautious stance may mean future rate cuts are less likely than markets expect. Switzerland continues its ultra-loose policy, keeping rates at zero and supporting its role as a funding currency. The U.S. repo market is stable, with the central bank effectively managing liquidity. Bond yields continue to rise, reflecting strong jobs data and concerns about government budgets. Treasury auctions are seeing healthy demand, but higher borrowing costs could become a long-term challenge. In equities, there's a rotation toward defensive sectors like utilities and consumer staples, while technology and solar stocks have been volatile due to policy changes and interest rates. Some individual stocks saw notable moves due to analyst ratings, political activity, or earnings expectations. Currency markets are being driven by central bank policy differences and risk sentiment. The US dollar is strong against the yen and euro, and the Australian dollar is volatile after the central bank's decision. The Chinese yuan remains stable. Options market activity shows institutions are hedging against downside risk in the broader market, while selling call options in strong technology names to collect premium. This reflects complex risk management strategies. The U.S. money supply continues to grow, which could add to inflation pressures. Investors are moving money into money market funds for safety and yield, especially amid global uncertainties. Business news highlights include a major financial institution expanding in Charlotte, creating new jobs and investing in the region, and a major online retailer's sales event, which supports consumer spending. Regulatory updates include new rules for market transparency and the introduction of new cryptocurrency investment products, reflecting the growing role of digital assets in traditional finance. Politically, the U.S. administration's trade policy remains a key market driver. The president extended the deadline for new tariffs, giving more time for negotiations but prolonging uncertainty. New tariffs on copper and anti-green energy policies have had immediate impacts on specific sectors, such as solar energy. Political activity by high-profile CEOs is also affecting individual stocks. The report concludes that markets are being driven by strong U.S. jobs data, shifting inflation expectations, trade policy developments, and central bank divergence. The strong labor market has reduced the likelihood of near-term rate cuts, pushing yields higher and supporting the U.S. dollar. Markets are showing resilience to tariff threats, but uncertainty remains high. Looking ahead, markets will be sensitive to upcoming inflation data and central bank communications. Defensive sectors, certain fixed income assets, and currency trades based on interest rate differences may offer opportunities. Tactical option strategies can help manage risk and generate income. Investors should prepare for continued volatility, focus on defensive and fundamentally strong companies, and consider fixed income and currency strategies that benefit from current trends. The integration of digital assets into mainstream finance is a significant development to watch.